Basically, the central banks don't understand that in order to stabilize the currency, you have to keep your gold, not sell it. And if you're going to sell it as a way to bolster your currency, the public isn't going to trust the currency to be gold backed, and they're going to dump it anyway.
Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics. And don't worry, Rafi's going to be coming your way in just a second. Although I did want to let you know that next Saturday, November 12th, we are going to be doing SilverFest. This is going to be SilverFest III, which we've done the last 2 years. And excited to do this again this year because I know a lot of people had fun. And fortunately, Rafi will be joining us again this year. Basically, it's an all day of digging into silver. We'll be live so that people can ask questions, and also the booth so that you can interact with people, make some new silver friends. David Morgan will be giving the Silver Year in Review. We'll be doing a silver outlook for 2023 with Bill Holter and others. State of the retail physical silver market with some of the dealers, and lunch with First Majestic. Then Rafi will be joining us on stage along with Ronan Manley to talk about the metal leaving the COMEX and LBMA vaults. Whole bunch of other panels. Rafi will be back once again at 3:25 p.m. Eastern time for Is the Fed Going to Break the Market? So going to be a fun day. Some silver miners round table and also an Ask the Experts section before we have happy hour to round out the day. So if you love silver and you enjoy watching the show and hearing from the guests, going to be a fun day where you can meet some other silver friends, hear Rafi and more. So sign up link is in the description field below. It's free to attend. It's online. We're going to have a lot of fun and hope to see you there. So with that said, now here is Rafi's Silver Report.
Well, hello there, my friends. Rafi here from the Endgame Investor with this week's Silver Report for Arcadia Economics. I want to start out by thanking everyone who has signed up to be my patron on Patreon for those interested in the Bible's perspective on monetary policy and economics, at least insofar as I see it. Those who have tried out a 2-week free trial of the Endgame Investor, it's getting fun up there, and I predict that it's going to get even funner as the months go by. And so today we're going to start off with record central bank gold buying not seen since 1967, a year before the London gold pool fell. Thanks, Monaco 64, for that tip. But demand for gold and silver has increased across all sectors except for ETF and paper demand, which has gone down, mostly from the COMEX and from SLV, and I'll show you those numbers in a second. We've got backwardation back in the silver market. This is day 3 where the spot prices are higher than the nearest futures. We've had this before, but if it continues for weeks on end, we can know that there is some serious monetary stress. And finally, we have price increases in the most basic of necessities in the high 20s, pushing on the 30% range for oils and fats, milk, cheese, and eggs, and bread and cereals in the UK. This is as core inflation, which excludes the most basic necessities being food, is kind of stable at about 6.5%. Food inflation is going wildly out of control. This is what you see at the beginning of hyperinflationary spirals. This week's Silver Report is brought to you by Fortuna Silver Mines, which just reported today that a huge capital expenditure project at Seguela, its new mine in Ivory Coast, it's about 83% complete as of October 31st. And the first gold pour is scheduled for 2023. Getting CapEx done at this point is very important because prices are about to explode to the upside all over the world. If you can argue that they haven't already, they're going to speed up even faster. And with a good portion of cost already locked in with the completion of this capital expenditure, it's going to be a good year for Fortuna. And I'll have Daniel Oliver explain in a recent panel that he had why mid-tiers are the target right now, why they are more advantageous to hold than majors. And Fortuna is a mid-tier silver mining stock. Take it away, Daniel Oliver.
And it's the juniors that I'm involved with that I like more because they are capital light. And so they do have more labor costs and those go up, but they're often jurisdictions where the labor costs aren't going up as much as other things are. And you don't have this massive CapEx that you have to fund that takes 2 or 3 years to build. This can be ever harder to do. Gold mining, unlike other industries, has a diseconomy of scale. So I think that the capital flows going forward will be shifting more towards the juniors that have rational projects that you can see being developed for a modest amount of capital as opposed to giant mega projects.
We have a huge central bank splurge on gold. This is taken from an article in Bloomberg. This graph says year-to-date gold demand resumes its pre-pandemic pace. That doesn't sound like such a fantastic title, but what is happening is that you have the biggest central bank buying since 1967. Here's the paragraph in Reuters. Buying by central banks in the third quarter far exceeded the previous quarterly record in data stretching back to 2000 and took their purchases for the year to September to 673 tons, more than the total purchases in any full year since 1967, according to the World Gold Council. You can see here in the bars that total bar and coin, which are the stackers, that demand has increased since 2021 and increased even further since 2020. It still hasn't beaten 2013 when the price of silver collapsed in that bear market year, but it is still pretty strong, and it is stronger than central banks. So here's paper gold demand. This is all paper gold, not just GLD. It is down 11.7 million ounces, and it was down another 12.9 million ounces in 2021, but we have 2 months left in this year, November, December, and I believe that we will exceed the drawdowns from 2021. Investors are losing interest and exposure to gold and to silver as an investment vehicle or with which to gain dollars from it. They're losing interest in that because it simply isn't working, though the stackers have pocketed the premiums, and if they want to, and if they're in some kind of a liquidity crisis, they can get a better price for their gold or silver than you can by selling a share of SLV or GLD. In silver, it's more extreme than gold. We are down 169.5 million ounces this year. That's 105 million ounces from SLV and COMEX combined, 48 million ounces from SLV. You see here on the top, this is the trust as of January 7th, 2022, 530.6 million, and now it is 482.6 million. That's 48 million ounces, plus 57 million drained from COMEX, is a total of 105 million ounces of the 169.5 million, just from SLV and COMEX. So those are the two biggest culprits when it comes to paper investment in silver futures and products. I also wanted to point out that even though central banks are buying more gold than they have since 1967, that does not mean that it's going to stabilize any currency. And I'll show you this graphically. Okay, so here we have the gold demand breakdown that we saw from the World Gold Council. This is the actual table of demand in tons. So jewelry demand up 13%. Yeah, that doesn't have much to do with the money markets, but anyway, we have investment here. So that's broken down into bar and coin, which is broken down further into bars and then coins and then rounds. Official coins is like minted by the government mints, and these are just like rounds that you get from, let's say First Majestic Silver or whatever. And then included in investment is ETF and similar products. So investment down 47%, but bar and coin up 36%, bars up 24%. Legal tender coins up 74%, and other rounds up 28%. And so here we have the collapse in paper investment products of 227 tons. So that overtook all of the increased demand for physical coins. And then you have the collapse in the OTC, which is direct paper trading between parties with no exchange in between. And I assume that big banks engage in that. And so here on the right, we have the central bank gold demand going back to Q1 2013 and 400 tons. That is quite a lot. That really outpaces anything that we've seen since 1967, as Reuters pointed out. So is this going to save currencies? And no, and here's the proof. Okay, so at the top here, this is the Turkish central bank gold reserves. So it was near 100 tons from 2000 to 2016, and 2017, the Turkish central bank started accumulating gold, serious amounts of it, from about 100 tons to 600 tons, just around March 2020 when COVID broke out. It topped out at around the time when governments decided to shut down the world because they had a cold and they were scared. And now you see, despite this serious gold stacking, the Turkish lira, and this bottom here is food prices in Turkish lira. Food prices is the ultimate, I guess, price index way to determine if you're undergoing hyperinflation or not, because That's really the end stage when people just like storm supermarkets and buy whatever they can get. So food prices are doubling on an annualized basis now. This is pretty much hyperinflation. Turks are already there. And why didn't the Turkish lira stabilize? Because they bought so much gold. They basically quintupled their gold reserves. Well, very simply, after 2020, they started selling their gold off to try to bolster the lira, because central banks don't understand that gold is money and their currencies are only gold substitutes or money substitutes. They're not actually money. So they think that in order to stabilize the currency, you have to sell gold, which stabilizes the currency. That's might be true in a very ephemeral sense, even evanescent. That's exactly what the Weimar central bank did in the 1920s. Before 1923, I think in 1921 or 22, they sold a bunch of gold and they temporarily supported the Reichsmark for a few months or so, but then it just kept collapsing. So basically, the central banks don't understand that in order to stabilize the currency, you have to keep your gold, not sell it. And if you're going to sell it as a way to bolster your currency, the public isn't going to trust the currency to be gold backed, and they're going to dump it anyway. No, I don't want to see central banks accumulating any more gold. I'd rather see the public, and the public is definitely outpacing them. But don't think that just because the central bank has a lot of gold, that its currency is going to stabilize. You got to stop printing it, and you also have to offer an exchange rate to redeem the currency for gold, or it will not stabilize. And of course, the one thing that central banks are not hoarding is silver. It is not worth it for them. It is not their money. Their money is gold. The public's money is silver. So if you are part of the public, then be your own central bank, and be your own central bank by stockpiling silver. And then you should make it through this monetary endgame pretty well. The settlement price is really the most accurate way to measure backwardation, in my view. So you have the settlement price for November silver at 1960 and the settlement price for December silver at 1959.4. That's about 0.6 of a cent. Not huge, but it's there. That was Wednesday, November 2nd. If we go to Tuesday, November 1st, see the same backwardation here, 19.673 cents versus 19.667 cents. Spot silver more expensive than the nearest futures in December. And it goes back to October 31st, where you have 1912.5 versus 1911.9. So it's about 0.6 of a cent, and it's been that way for 3 days. That's not that big of a deal, not that much to get excited about yet, but if it continues for 3 or 4 weeks, then we could see something interesting. And meanwhile, we're still seeing the draining of COMEX and of the LBMA numbers, which we'll have next week. And we've got about 4 months left of registered silver supplies, and it's ticking down fast. Now we're going to go to the UK to see what is happening there in the consumer markets. And you shouldn't watch core inflation or PCE or CPI. Not that you shouldn't watch them, not that they're like pornographic or anything, but they are mostly a waste of time because they include prices which do not matter when people are panicking over purchasing power. That is when they panic over food and the most basic of necessities they need to survive the next day. And so what is happening in the UK now? Well, exactly this. This is food inflation, food prices in the UK. This is really egregious, and it should not ever happen in a first world country. It is way out of control. So it says here, prices for food and non-alcoholic beverages in the UK rose by 14.5% annually in September of 2022. Okay, but look at these categories. The highest on record and picking up from 13.1% in the prior month. It was one of the drivers of the increase of the overall CPI, et cetera, with notable price growth in oils and fats, 28.1% versus 26.3%. Wow. Milk, cheese, and eggs up 24.3% versus 22.1%. Bread and cereals, 14.5 versus 11.8. So protein is getting really scary expensive, with price increases of near 30% in fats and 24% in milk and protein. Oh my God. And if we take a look at the FTSE, we see that in the last year, the FTSE has gone pretty much nowhere. It is at 7104 and it was on 7310 earlier in the year. Stocks are down in Britain while food prices are going parabolic. This is the beginning of the end of the pound. But all in all, we saw what happened yesterday when the market thought that the Fed was going to step off the gas of rate hikes and maybe hike instead 50 basis points instead of 75 basis points in December. But then Powell kind of whipsawed the market and had everyone expect a 75 basis point hike. The point is, Everyone knows what's going to happen when the pivot does take place. Nobody knows the exact trigger that's going to force it. So here I'm going to give one more slot to Daniel Oliver to explain what it is exactly that we're waiting for. We all know it's coming. We just do not know from where. And when the final trigger is finally pulled, it will be a surprise approximately to everyone, including ourselves probably, because it has to come from a place that is not being watched. Otherwise, it will be protected by central banks, but the trigger will be sprung, it will be pulled, and from there, the metals, and especially silver, will reach new highs, regardless of fiat numbers, definitely in purchasing power.
So I don't think that some economic number is going to change the Fed's mind about pivoting. I don't think it'll be some employment number. I think it will be like a UK situation where, or the repo market in September 15th of 2019, when something breaks. The U.S. pension funds, there's a run on the bank, is what happened in the UK last week. So I think the pivot will happen not through some economic thing, but something breaks, a big institution, a currency goes down, the yen or the pound or U.S. pension funds or something like that, and the Fed will say, oh, the oh shit moment, and they'll have to start printing trillions of dollars at that point to save the system. So I think that's what we're waiting for. I don't know exactly what it's going to be, but certainly the pressures are building, and you see pressures all over the world building, and I think it's not long from now. It was one thing when they bailed out retail mortgages in 2008, but can they really bail out the UK and Japan and the pension fund industry? I mean, these things are huge. And so the amount of money you got to print to save the pension system is not $1 trillion or $2 trillion. It's like $5 trillion. So will they do that? I mean, I think they will if they have to. And that's, again, what the next stage in the global bull market is going to look like.
This is Rafi, the Endgame Investor, coming at you with this week's Silver Report for Arcadia Economics. I wish you guys a good and healthy and shiny week ahead.